Guys, welcome to another Trade Genius podcast. Bob and Phil here. You're viewing a Venus flytrap. I wonder why. Let's get into this video.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. All right, Bob, a lot of things look trappy here. Cue us in.
Yeah, just like a Venus flytrap, you're getting attracted here. And, I've been actually seeing online that people are saying we're ready to break out to new highs again, and the cognitive dissonance in this stuff is just amazing to me that never before in the history of stock trading does the market make a new high as we're raising interest rates.
Right.
And it's just really a matter of people are looking at the Fed trying to rescue the banks, and they're making an assumption that money is going to translate into buying power where the economics don't work. But what's really happening, we'll show you on the first chart. It's the same old game, Phil. And what people don't understand about what's happening in the stock market, this isn't your daddy's stock market, okay? So they've created two things. They've created this market cap weighted index, and they created passive investing. And these things were done by design because now they're in full bloom right now. You got passive investors that just throw their money into a 401k. The investment advisors just throw them into these market cap weighted entities, and then market makers and the hedge funds and the big banks, they turn around and then they use option contracts to leverage just the top, I would say top 5% of the market. Mm-hmm. And they just pour options into it, leverage in other words, and it lifts those stocks up, which lifts the entire index up. You know how it is, like you're hanging around with the cool kids, right? Well, you're cool by, location. And, when that cool kid's no longer cool anymore, you're going to have the same problem on the other way down. And that's what's happening here. These jaws snap shut, Phil. And then when the big caps start to roll over, your stocks go down regardless of how good you do, just because you're caught in the same trap. And here's something people haven't seen because people are so, bewildered by the market. Look at the NASDAQ. It's still a head and shoulder pattern. This is typical what you have in a topping pattern. You got that initial thrust, and then it went ahead and it made a higher high, okay, and then it pulled back, and now we have to watch this second high, this one that basically this week is hitting its highs. Is that when that rolls over, that sets the stage for a move that basically will unwind everything from the bottom of 2022, from the top of 2021. That's a measurement, Phil, and then it's going to drop that farther. So we're going to probably unwind all the way back to 2018 pricing in NASDAQ.
Yeah.
Nobody's ready for that.
No, but you're right, though. That is the measured move.
Yeah. And so, yeah. And look, normally I would say, hey, let's kind of keep an eye on this thing. Maybe it's going to double top. But, they've been doing every trick in the book here to try to keep this market from literally imploding. And look, the market only goes up because of liquidity. Yep. And so, and this is the thing. Remember when Danielle Martina Booth said, oh, they're not adding liquidity to the market. It's all a blah, blah, blah. Well, here you go. Ever since that stick save on the regional banks, the stock market's gone straight up. Yep. Because the liquidity leaked somehow in some way into this market. Mm-hmm. And that's going to dry up with Yellen.
Agreed. And that was the argument that was going on about, they're filling a hole. But that's why I said, well, the hole was created because the liquidity went elsewhere. Liquidity transfers, wealth transfers. It doesn't just evaporate unless the Fed and the government are actively taking M2 supply out of the system, which they are. But whenever they do what they did last month, no matter how you want to spin it, the way this market is programmed, the way it reacts to Fed action, those actions will always make stock market prices rise. It's just the way it is.
Yeah, absolutely. To not beat that dead horse, but to flip back to the NASDAQ for a second, there's a really cool chart that kind of proves my earlier point about the Qs. So the top black line is the triple Qs, and then the one below it is the triple Qs equal weight, meaning not accounting for the market cap weighting of the big boys. And you can see every time you get a divergence like that, it follows the market down, not up. So once again, and just for people, we always get these haters on there saying, oh, you guys are gloom and doom. There are pockets of areas we're making really good money. We're just telling you that you need to either start transferring, raise cash, get into the long bond, and get out of these tech names, because when they roll over, you're looking at a potential 40-50% retracement from the highs of 2021. And I don't think people can absorb that. And it's going to come fast. I think this move is going to be a thief in the night move, Phil, because too many people are just jumping the dips. And I think what they're going to do, it's just going to break one day, and the dip buyer is going to get rolled over. Remember, 40% of market volume now is this game they're playing with the options.
And then with FOMC coming up on Wednesday, every time, if you consider this market being a bear market since the end of 2021, every time we've run up hard into the FOMC has just been a pivot point and knocks it back down. And I mean, this is one of the hardest charges up. I think August of last year was probably on par with as far as kind of that unrelenting push. And I just think that, man, the timing here is pretty wild as far as the severity of the push going into Wednesday's meeting. And then as our newsletter subscribers know and our VIP guys know, we were showing the liquidity charts. It's screaming at you. Like, this is, when we see these readings, it's basically like this coming week, it's very dangerous to be getting long this week, because it's usually going to be a turning point in the markets. And then I think we're something like 300 points over value right now. So a 300 point drop in the market, I think that would, and you got to be mindful that this could be the actual top before we really start to go down into what we would consider the recessionary period or the recessionary lows. And so that's a long way to go, guys. I mean, we probably will take out last year's lows if that's the case. So you need to really be considerate about, where you are in your portfolio, because the underlying data here is not good. And then these next slides that Bob found are actually going to kind of drive that point home even more.
Yeah. And if you can throw that chart up here, what's happening here is that, I'm telling you guys, nobody can complain if they lose money on this next stock market sell-off. Nobody can complain. They've given you every opportunity to position yourself for safety. Every opportunity.
Yep.
And here's another one. And it was really interesting because our family is a long-term holder of ExxonMobil stock. And they just did their earnings report, another great earnings report. ExxonMobil CFO, they just did a reporting of their earnings, and they were getting pressed pretty hard on, hey, what are you going to do with this cash hoard? You're going to get back to the investors? Are you going to buy something? You're going to do this? You're going to do that? She goes, I don't have to do anything. She goes, I'm getting 4 to 5% on my cash, which is higher than what I'm paying on my debt. And I'm in no hurry to buy anything. And I think we're seeing that across the board is if she's able to grow the value of her company without taking any risk, why wouldn't you do that? And it's the same with personal portfolios too, Phil. I'm getting 5.08% on 90-day T-bills now. Mm-hmm. I mean, that's insane. Why would I reach out for a chance of losing half my portfolio value to squeeze for another 5 or 6% long-term value, right? So, and that's what this chart reflects, that you're starting to see the savings rates go up, okay? People are just saying, hey, I'm getting money now. It's growing. I don't have to invest it.
Yep.
And this next chart, I think this one you found, so I'll let you speak to it. It's really about, the wealth gap here, if you want to just throw in on that one, Phil.
Well, and I think this wealth gap is just telling us that, again, the way that the system is, it's skewed to enriching the wealthy. And, if you're not wealthy, it's just harder and harder. It's much easier to deal with inflation when you're wealthy. Okay. There's a certain bell curve that happens and you're able to deal with it. And if you're not over that bell curve or ahead of that bell curve, then you're getting buried just as much as those guys are getting richer, you're getting poor. And even, you could say, well, if you're middle class, you're kind of in the middle, but even that's getting hammered now. And people are, a lot of these middle income earners are starting to look at a job market that's changing. We're having a lot of jobs getting more and more automated. And I'm not talking just robots. I'm talking about AI and software fields. I mean, look at look at Twitter as an example. 75% of the workforce slashed and they're still running Twitter. Like, can you tell anything's wrong? I can't. Twitter still works. So I think we're going to start seeing a lot more layoffs. Again, this is what the Fed wants too now. But, by and large, I think that the way that being the world's reserve currency, unfortunately, one of the side effects is going to be wealth inequality just by design of the system. And so this is why we try to hammer home the point of like, look, you can outpace the system if you play it right. And like right now in this market, like they want everybody plowing into the market, all of the CTA, all the advisors, they just want you to give them more money to put to work in the market. We're telling you this is a really bad spot to do that. Okay. And this is why nothing ever changes. However, if you guys start hedging or you go to cash, market pulls back another 30, 40, 50%, and then you go back in. Well, guess what? When you do that, because now the cycle's kind of reset and we're going to go into another, several years of the market going up, you've just changed dramatically your wealth building program over the next couple of decades. Now, of course, that's age dependent, but let's say most of you are middle aged, that's still a ton of time left to take advantage of the situation. So break the cycle is what I'm trying to say with this chart here, Bob.
Yeah, and look, and it's not even just stock market. In 2008, if you own TLT in that 12 to 18 month turmoil that we had, you doubled your wealth in holding that stock. It doubled, literally doubled. So you could be 75 years old and you'd be like, man, what the hell do I do? Well, you know what? If you're in cash, you go to long-term bonds, the market plunges, Powell has to panic out of it. TLT goes from $106 to $180, and you have $100,000 in there. Well, guess what? You just jammed up your wealth by 80 grand. Right. And that's happened before and it's going to happen again. This notion that we're going to lose control of the bond market is not understanding the Fed can do whatever they want to do. Look at Japan's done for 30 years. So at some point, the politicians are going to be putting guns to the head. And we've already showed you what happened to Australia. Okay. So the politicians will not lose their job because of the Federal Reserve. So at some point when this thing gets nasty, they're going to come in, they're going to do yield curve control. And those people sitting in these long bonds, long treasury bonds, are going to make an absolute killing. So it's not just basically sitting in cash, hoping and praying. You're getting paid now 5 to 6% for doing nothing at all. Okay. Inflation's coming down in that sense, in terms of, most items. And when we go into recession, we will get a dip in the cost of living. Then you want to be reset ahead of it. So guys, we're going to keep beating on this horse here because look, the market's not going anywhere. I think we're at the same place we were since 2019. So it's not like you're saying, God, we're missing the most tremendous move. You're missing some wiggles sometimes, but, there's great opportunity. And we trade those, so you have to be in the room to see it. We're just talking macro here on the podcast.
Yeah, and I think that this is playing out very similar to other past bear markets in that, remember we were talking about this market has dipped already and the yield curve hadn't really bounced yet. Well, now the yield curve bounced. You're seeing the market hasn't really rolled over yet, but that's actually kind of par for the course in terms of how the market correlates to the yield curve inversion. So now the yield curve inversion is bottomed. It's shooting back up. Now the market's starting to get a little exhausted. And this is the dangerous part of the market. I know we've been warning for a couple months now, but this is the next phase that we get into. And I don't know if it's this high that triggers it, but this is the time where from when the yield curve inversion bottoms, which was a couple months ago now, till now, and this rolling over, and then you've got Yellen and the debt ceiling ahead of us too. This is very perilous right here. So personally, for me, I think we have a really good chance of going and taking out from here, from this area, more or less, taking out last year's low. And that's why I'm very cautious. People are like, well, did you, like this last bounce up, I didn't really participate because I'm looking at everything and the risks to the downside aren't worth me trying to get in long. The position I'm taking is looking at scaling in this week short the market because I just think everything right now favors a move to the downside. And I think the risks are way higher that we're going to have a downside move versus maybe a few more days up. It's not worth it for me to get long and suffer through a drawdown.
Well, that's a good thing to tell people too. People trade different ways. You like taking the big, we call the lazy swing. That's, that's a term. You take the lazy swing and you grab the 100 points on the short side. I'm a little bit more of a short swing trader. And what did we tell people on Wednesday? We day traded SDS 2 days. I said, hey, we're going to flip to SSO because when you have a red Wednesday for the week, Thursday and Friday tend to be green, regardless of the market itself, just the
Right.
nature of people shorting. And what happened? Thursday and Friday were green. So, we didn't take too much risk, on the long side, took some shots because, big old Mr. Fed sitting out there, Tuesday, Wednesday. So you day trade this stuff, there's plenty of opportunity. Short swing, there's some really good opportunities. But we're watching Bitcoin, and Bitcoin is definitely a canary in the coal mine. So if you want to get a sense to where liquidity is going, it moves in and out of there, I think the fastest and the fastest. That gives you kind of a sense saying how much risk you want to take if you're day trading or short swing trading. So many opportunities. We get so excited about this stuff. But enjoy this podcast. Give us your thoughts. Tell us what you like to talk about, what you're interested in, and we'll try to bring that to you guys. This is your show. Next week will be interesting. On Wednesday, Phil will do the live action for the Fed announcement, and so be sure to tune in on that. We'll give you guys more information on Monday, Tuesday. It's always a crowd pleaser. So Phil on the mic, and he kind of just reads the minutes off and talks about what they're saying and what the reactions are. So anyway, with that, enjoy the rest of your weekend.
See you guys. Thanks for watching.
Trade Genius.